Billionaires have a way of investing. They are obviously successful, but what makes them so successful apart from other investors? That's what today's video is going to cover. So make sure you watch until the end to uncover the secrets that billionaires are hiding from you. But first, don't forget to subscribe if you want the market to work in your favor. Now let's get right into the video. 1. You might think that investing in the stock market is all about skill. That is not true. It depends a lot on luck, and even the best investors are very lucky. Most investors don't like to admit it, but in many cases they have been lucky enough to be at the turning point of trends. Sure, investing is still 90% skill and only 10% luck, but without that 10%, you really can't be a successful investor. Charlie Munger, a very successful investor and best friend of Warren Buffett, said that he believed some part of his success was luck, and that he was uncertain if he could do it again. 2. Remove the weeds and water the flowers. This is a poetic expression. It means you need to get rid of your losing positions quickly and hold on to your winning positions long enough. This is the key to successful investing. Successful investors don't get all their trades right. Their success rate may be as good or bad as yours, but they take care to remove the weeds and water the flowers. 3. You can make money more often with a passive approach. Like it or not, but in the long run, you will make more money simply by investing in an index fund. It will be odd years when your skills count and multiple baggers come your way. But most years you will do better in an index fund. 4. No one became a millionaire by negotiating with others. Don't ask for tips, as no successful investor will ever tell you. No one became like Warren Buffett or George Soros, asking for trading tips and investment lessons. Learn your lessons and gather your wisdom yourself. This is the only way to do it. 5. One bad decision can ruin your performance. This is important if you are still a small investor. However, we have seen that the biggest investors lose most of their profits in some trades. Don't underestimate the market's ability to capture your profits, no matter how big. 6. The hottest stocks are overpriced because the market is smarter. Nothing is cheap, and especially good quality stocks. If everyone knows about a stock, you can be sure that it is overpriced. The key to smart investing is to take that big risk for tomorrow's leaders. Just following the crowd won't get you too far. 7. Doing nothing is also an important investment decision. Many of us grow up believing that successful investing is all about action. That is hardly the case. Good investors have the patience to wait for years when nothing happens. They also have the discipline to wait on the sidelines when the entire market collapses on each other to buy or sell stocks. Most successful investors don't talk about it because it sounds too prosaic. But it is just as important. This is not inaction, but willful passivity. 8. Thrift wins. Approach stocks like a basement bargain and pinch pennies. Treat your stance on stocks exactly as you would on bargain basement deals. Get the best price possible even if it's good stock. Save money on brokerage fees and minimize opportunity costs. Becoming an absolute penny pincher does a whole lot of good to your investment success. 9. Smart investors don't buy stocks. They buy underlying companies. It is much more complicated than it seems because there are too many dynamics involved. More importantly, remember that everyone from Buffett to Soros to Lynch diversifies their risk. A centralized approach is not very smart in the real world. 10. You have to reject 100 stocks before choosing one. Stock picking is a lot more laborious and boring than you might think. It is estimated that the average investor needs to divest at least 100 shares before canceling one share becomes a multi-bag buyer. 11. Wealthy investors know how to be patient. Investing can't make you rich overnight, but if that's what you're looking for, you might as well buy a lottery ticket. You have to buy and sell at the right time, and it depends a lot on luck. You will most likely lose most of what you invest this way. Successful investors understand they must take a long-term view. They focus on finding strong companies that they believe will still be at the top of their industry in a decade or two. They tend to be a bit more skeptical of companies that haven't been around long enough to prove themselves. Investing like this doesn't usually bring huge profits overnight. But over several years, you will see a slow and steady upward trend in stock prices. Short-term losses may occur, but are usually not a problem for those who invest for the long term. 12. Wealthy investors don't let their emotions get in the way. Money can evoke many emotions. Seeing a stock rise may prompt you to buy more in hopes of increasing your profits, while watching a stock fall may prompt you to sell immediately to avoid further losses. Sometimes buying or selling stocks is a smart decision, but it shouldn't be done on emotion alone. Ups and downs are a natural part of investing, and even the wealthiest investors sometimes lose money. The difference between them and less successful investors is that wealthy investors are not disappointed by these short-term changes. Instead, they look to the bigger picture for clues about what to do next. If they see that the company is steadily losing market share to a competitor, they will probably sell their shares. But they don't sell stock when a profitable company has a bad quarter. They understand that every business has its advantages and disadvantages. In the long run, the stock market tends to rise. It may sound deceptively simple, but if you follow the 12 tips above, you can significantly increase your wealth over time. If you are new, start small and invest.